Hello viewers, welcome to my channel. I'm Hasham Ali Khan. I got many requests from the students to make short revision videos on different topics of advanced accounting. So I have decided this is the first video. In this video, I'm going to explain you about the different topics of first chapter of advanced accounting, that is partnership accounts 1. So first of all, the meaning of the term partnership according to Indian Partnership Act 1932. Partnership is the relationship between persons who have agreed to share the profits of a business carried on by all or any of them acting for all. So this definition contains all the features of partnership. So partnership is the relationship between persons who have agreed to share the profits of a business carried on by all or any of them acting for all. Now, features of partnership: at least two persons are required. One person cannot make a partnership, minimum two. And maximum, according to Companies Act 1956, old Companies Act, the maximum number of partners are 10 in case of banking business and 20 in case of any other business. But this provision is according to old Companies Act 1956. According to New Companies Act 2013, the maximum partners in a partnership firm is 50. Agreement. Every partnership is based on agreement. The agreement may be oral or the agreement may be in writing. Without agreement, no partnership can be formed. Lawful business. The partnership is made only for conducting a lawful business. For illegal activity, the partnership will not be accepted by law. Then to share the profits. The main purpose of this partnership is to run the business and earn the profit, sharing the profit between the partners. Sharing the profit means including sharing the losses. Carried on by all or any of them acting for all. All the partners will have a right to take part in the conduct of the business. Every partner can take part in the business functioning. Unlimited liability. The partner's liability is unlimited. That means not only the business assets, but also the personal property of the partner is liable to pay the debts of the business. These are the features. Now, partnership deed. The agreement, the partnership agreement, if it is in writing, it is called partnership deed. It contains the name of the partners, the capital contributed by partners, profit sharing ratio, interest on capital, interest on drawing, etc. Then rules applicable if the absence of partnership agreement. Sometimes, if there is no mention about a particular item in partnership deed, then Indian Partnership Act says profits and losses should be shared equally. Actually, profit sharing ratio will be specified in the partnership deed. If the partnership deed is silent, then Indian Partnership Act says profits and losses should be shared equally. Secondly, entitled for any interest or on capital or interest on drawings. That means no partner should be given any interest on capital or interest on drawing. If it is written in the partnership deed, then the partners are allowed interest on capital. Otherwise, if the deed is silent, no interest on capital. Loan from a partner. If a partner has given a loan to the business, then interest on that loan will be allowed at 6% per annum according to Indian Partnership Act. Then every partner has a right to take part in the conduct of the business. So these are the terms which are assumed if the partnership deed is silent. Next, capital account. How to maintain the capital account? Two methods are there: fixed capital accounts and fluctuating capital accounts. If the partners have decided that capital accounts should be fixed, that means two accounts will be maintained for each partner. One account capital account, another account current account. Which method? Fixed capital method. The capital will remain same beginning of the year till end of the year. But all adjustment regarding interest on capital, interest on drawing, salary, commission, share of profit, all these adjustment will be done in current account. So two accounts are maintained under fixed capital method. Fixed capital, capital account, one account, current account, another account. All adjustment will be made in current account. The capital account will show credit balance, whereas current account may show credit balance or current account may show debit balance. If it is showing credit balance, take it on the liability side. If it is showing debit balance, take it on the asset side. Fluctuating capital. This is also one of the methods of maintaining the capital where the capital account is fluctuating because all adjustments are made in one account only. Every partner, one account is their capital account. In that account, all adjustments are made regarding interest on capital, interest on drawing, salary, share of profit, etc. That's why it is named as fluctuating capital. Now, profit and loss appropriation account. In case of sole trading concern, all the profit will be given to sole trader only. So there is no appropriation. Appropriation means division. In case of partnership, the profit has to be divided between the partners. So how to distribute the profit between the partners? By making appropriation account. In this appropriation account, credit side, net profit, which we got from profit and loss account. So first we make the profit and loss account, find out the net profit. That net profit should be taken on the credit side. And if interest on drawings are there, that interest on drawing will be taken on the credit side. And interest on capital is there, take it on the debit side. Salary, debit side. Commission, debit side. After making all these adjustments, find the balance. Normally credit side will be more, debit side will be less. The balancing figure you are getting on the debit side, that is net profit divisible. And this divisible net profit will be shared by the partners in the profit sharing ratio. This is all about profit and loss appropriation account. Next, interest on drawings. If drawings are given only a single figure, so we can assume that drawings are made during the middle of the year, so half year. But interest on drawings will be calculated. So whatever the drawings are there, that will be multiplied by percentage of interest into 6 by 12. We assume that drawings are made in the middle of the year. If drawings are made periodically every month, then we have to see when the drawings are made. If the drawings are made at the beginning of every month, then 6.5 months interest will be calculated. If the drawings are made at the end of each month, 5.5 months interest will be calculated. That is the provision regarding interest on drawings. Now, admission of a partner. See here, when a new partner is admitted, some adjustments are to be made in the accounts. What are the adjustments to be made when a new partner is admitted? First, treatment of goodwill. Second, revaluation of assets and liabilities. Third, adjustment of regarding accumulated profits and losses. Change in profit sharing ratio and adjustment of capital according to the new profit sharing ratio. These are the adjustments required whenever a new partner is admitted. So first, treatment of goodwill. If goodwill is privately paid, no entry will be passed. If goodwill is brought in cash, then we have to pass the entry. First, bank account debit, new partner's capital account credit, because new partner is bringing in cash for goodwill. So bank account debit, new partner's capital account credit. And this new capital, this goodwill is brought, and this goodwill will be transferred to old partner's capital account. In that case, new partner's capital account debit, old partner's capital account credit. New partner's capital account debit, old partner's capital account credit. That means goodwill is shared by the old partners. Next, goodwill is evaluated and raised in the books. Sometimes goodwill is not brought in cash but raised in the firm. In that case, new partner's capital account debit, old partner's capital account credit. That means goodwill is adjusted in capital accounts, right? Sacrificing ratio. Whenever a new partner is admitted, the old partner will sacrifice in favor of the new partner. Then the sacrificing ratio formula is old ratio minus new ratio. So sacrificing ratio will be calculated when the new partner is admitted. So old ratio minus new ratio. This will give you sacrifice. Revaluation of assets and liability. When a new partner is admitted, normally the assets and liabilities will be revalued. So now you have to see whether asset is increasing or decreasing. If there is increase in asset, entry will be asset account debit, revaluation account credit. If there is decrease in asset, reverse the entry, revaluation account debit, assets account credit. Similarly, if there is increase in liability, revaluation account debit, liability credit. If there is decrease in liability, liability debit, revaluation credit. After making all the revaluations, find out the balance in revaluation account. The balance in revaluation account shows the profit or loss on revaluation. If the credit side is more, debit side is less, there is a profit. The entry will be revaluation account debit, old partners capital account credit. If there is a loss, the entry will be reversed. That means old partners capital account debit, revaluation account credit. These are the entries for revaluation account. The last point is retirement of a partner. A partner may retire by giving a proper notice to the other partners. So at the time of retirement, again adjustments are required. The adjustments regarding treatment of goodwill, revaluation of assets and liability, treatment of undistributed profits or losses, then transfer of amount due of retiring partner to his loan account. So regarding treatment of goodwill, so when goodwill is to be adjusted in the books at the time of retirement, the entry will be remaining partners capital account debit, retiring partners capital account credit. The retiring partners capital account should be credited and remaining partners capital account should be debited for adjusting the goodwill. And revaluation of assets and liability, exactly same what we have discussed in partnership. Then treatment of undistributed profit. If there are any reserves or undistributed profit, that should be distributed among all the partners. The entry will be general reserve account debit, all partners account credit. The next one, transfer the amount due. After making all the adjustment, if any amount is due to the retiring partner, that should be transferred to his loan account. The entry will be retiring partner capital account debit, retiring partner loan account, or simply loan account credit. Loan account credit. These are the adjustment in case of retirement of a partner. The next thing is gaining ratio. At the time of retiring, the remaining partners will gain. Suppose 4 partners are there, A, B, C, D. So earlier 4 partners, now D is retiring. So when D is retiring, A, B, C will gain. The ratio will be old new ratio minus old ratio. This will give you gaining ratio. Now differences between sacrificing ratio and gaining ratio. Sacrificing ratio will be calculated at the time of admission of a partner, and gaining ratio will be calculated at the time of retiring of a partner. The formula for sacrificing ratio is old ratio minus new ratio, whereas the formula for gaining ratio is new ratio minus old ratio. In the case of admission, the old partners will sacrifice in favor of the new partner, whereas gaining ratio, when the remaining partners will gain because one of the partner has retired, gain in the profits of the business. Then differences over death of a partner. This is the last topic in this unit. The treatment of adjustment in accounts on death of the partner is similar to retirement of the partner. Only the difference is retirement of a partner is a planned activity, whereas death will be completely uncertain. At any time death may happen. So whenever there is a death of the partner, the executors of the deceased partner, are entitled to the share capital, to the goodwill, to the revaluation profit or loss, to undistributed profit, and also the profit from the last balance sheet till the date of death. All these adjustments have to be made on the death of a partner. This is the complete theoretical part of partnership accounts 1. Inshallah, next video I'll take the next chapter, partnership account 2. But for detail, I suggest you to go to the playlist of my channel, select the subject advanced accounting. In that you get the detailed videos of all the chapters with the problems.